Negative gearing could be on the chopping block again. And every time this conversation comes up, panic spreads through the entire property market. Some people say property prices will crash. Others say rents will explode. And some investors are threatening to sell everything. But here's the truth. Most Australians don't actually understand what negative gearing is, how it works, what really happens if the government removed it. So in this video, I'm going to break it down in plain English. We'll cover what negative gearing actually is, why investors use it, what could happen if it actually gets removed, whether property prices would actually fall, and most importantly, how smart investors adapt, no matter what the government does. Because at the end of the day, strategy beats tax benefits every single time. For those that are new here, my name is Aaron from Investor, where we actually help everyday Australians build long-term wealth through strategic property investing. If you enjoy educational property content without the hype, without the fluff, hit the subscribe button. So let's get into it. So I want to start with the basics here. Negative gearing is one of the most misunderstood concepts in Australian property investing. And honestly, a lot of people think it's some magical loophole that makes investors rich overnight. The secret is, it's not. In simple terms, negative gearing means your investment property costs more for you to hold each year than the income it brings in. So here's an example. Your rental income is $30,000 a year, but your expenses, which is your interest, your rates, insurance, maintenance, depreciation, let's say that totals $40,000 a year. That means you're running at a $10,000 loss. Under current tax rules, that loss can generally be deducted against your taxable income. So if you earn $120,000 from your job, the government may effectively treat you as earning only $110,000 for tax purposes because you had a $10,000 loss. Now that's essentially negative gearing in a nutshell. Now here's the important part. Negative gearing does not mean you are making money. You're still losing money each year from a cash flow perspective. The tax deduction simply softens the blow itself. The real reason why investors buy negative geared property is because they're betting on long-term capital growth. They're willing to lose a little money today in the hope the assets grow significantly over time. So contrary to what some people think, investors don't buy properties just for tax deductions. Nobody spends $1 to get 30 cents back. The goal is still wealth creation. Now, every election cycle that I can think of, negative gearing becomes a political football. Critics on one side argue that it pushes up property prices. It gives investors an unfair advantage over home occupiers. It encourages speculation and it costs the government billions in tax revenue. Then on the other side, you've got supporters that argue the exact opposite. They say negative gearing encourages investment into housing supply, which in turn helps create rental accommodation for the growing population. Honestly, both sides make arguments that have some validity. But here's where the conversation often becomes oversimplified. People act like removing negative gearing would suddenly make housing unaffordable for everyone. But property markets are far more complex than that. Housing prices aren't driven by one single thing. They're driven by supply and demand, population growth, interest rates, construction costs, lending policies, wage growth, immigration, land scarcity, infrastructure, so much more. Negative gearing is just one piece of the much larger puzzle that is the property market. So let's talk about the one big question here. What actually happens if negative gearing is removed? First of all, it depends on how it's removed. Historically, proposals have included removing it completely, limiting it to only new properties, grandfathering existing properties, or restricting how losses can actually be claimed. And each scenario would create completely different outcomes here. But let's talk generally about the likely impacts. One of the biggest risks is pressure on rental supply. Australia already has an extremely tight rental market in many areas, as we discussed before in other episodes. Vacancy rates in some suburbs are critically low. So if negative gearing becomes less attractive, some investors may decide not to buy at all, not to build, or to sell their existing investment properties. So the problem is tenants still need somewhere to live. And if supply falls while population keeps growing, rents can rise even further. We actually saw something very similar to this back in the mid-1980s when negative gearing was briefly removed nationally. Some cities experienced noticeable rent increases during that period. Now, to be fair, economists still debate exactly how much of that was caused by negative gearing changes versus broader market conditions. But the risk to rental supply is very real. Now, big question here, right? Would property prices crash? Personally, I think a nationwide collapse is highly unlikely, purely because of negative gearing changes alone. Could some investor-heavy markets soften? Absolutely. Especially high-density apartments, lower growth investment stock, or areas that are heavily reliant on speculative investors. But quality assets in strong locations, genuine owner-occupied demand, history suggests those markets tend to remain resilient over the long term. Remember, owner-occupiers make a massive part of the market too. And Australia still has population growth, housing shortages, high construction costs, and limited land supply in desirable locations. And those structural drivers don't disappear overnight. And they definitely don't disappear just because we remove negative gearing. Now, here's the part nobody actually talks about enough. Too many investors rely on tax benefits to justify bad investments. And that's dangerous. If the only reason property makes sense is because of a tax deduction, it probably wasn't a great investment to begin with. Smart investors focus on the fundamentals first. Strong locations, long-term demand, scarcity, infrastructure, population growth, cash flow management, and asset quality. Tax benefits should enhance the strategy, not be the strategy. Because governments change policies all the time. Interest rates change, laws change, tax laws change, lending rules change. The investors who survive long-term are the ones who adapt. So if negative gearing changes the future, what might smart investors do differently? So we may actually see greater focus on cash flow positive properties, more emphasis on the yield itself, more strategic debt reduction, increased demand for dual income properties, we make more income, more investors actually targeting stronger land value ratios, and potentially more focus on development or value add opportunities. Investors may also become a lot more selective. During easy money periods, people sometimes buy almost anything, assuming growth will save. But if tax settings become less favorable, asset selection becomes an even more important factor. And honestly, that's not necessarily a bad thing. It could invest more strategically and less emotionally. At the end of the day, negative gearing is important, but it's not the sole reason Australian property has performed strongly over decades. Property has grown because of population growth, inflation, land scarcity, credit expansion, supply shortages, and the simple reality that people will always need somewhere to live. So could policy changes create volatility? Absolutely. But successful investors don't build strategies based purely around one tax rule surviving forever. They build adaptable portfolios designed to perform across different market conditions. Now, I'd love to hear your thoughts. Do you think negative gearing would help housing affordability, or would it make the rental crisis worse? Drop your thoughts in the comment below. I read every single one of them. And if you want help building property investment strategy designed around long-term fundamentals, not hype, not fear, not government handouts, there's a link below to book a strategy session with the Investor team. Don't forget to like, subscribe, and I'll see you in the next video.